If you just look at things, just look at the political scene. We have, as a result, really, of the war in Ukraine, the sanctions that have been imposed on Russia from the West, and the fiscal contributions for military equipment and so forth that the Europeans have put up, they've almost bankrupted themselves. And we've had one government falling after another, including two of the big powerhouses in Europe have dysfunctional governments, or a government in limbo in Germany and essentially a dysfunctional government in France. And the economies in Europe are just completely tanked and falling way behind the U.S., for example. How about the United States? A new sheriff will be in town, Donald Trump, starting on January 20th. And Trump makes a lot of noise, but in reality, we don't exactly know what he's going to do. So that's an uncertainty. The U.S. economy, I think, will slow down in 2025. Now, as you know, John Greenwood and I use the quantity theory of money to predict the course or trajectory of nominal national income, nominal GDP, if you will. And nominal GDP includes the real rate of growth in the economy and inflation. We've gotten the inflation thing absolutely right on target, going up and going down. The one thing that we haven't been good on is the timing of the slowdown that will eventually occur, because the money supply has been contracting since the summer of 2022. And we've only had 4 big contractions in the money supply since the Fed was founded in 1913. All 4 of those have resulted in recessions, or in one case, actually, the Great Depression. The contraction of 1929, 1933, the money supply led to the Great Depression. So this hasn't happened yet, but it's baked in the cake, and it will happen. It's just been a lot slower in coming than Greenwood and I ever imagined. The inflation component is also continued. That we've been right on target with. It has been falling, and it will continue to fall. I think we'll probably see some headline CPI numbers that are below the Fed's target at 2% in 2025. So that's kind of the economic scene and, shall we say, the political scene in both Europe and the United States. What about the big elephant in the room? China. China's in a slowdown because, of course, the money supply is growing at a much slower rate than Hanke's golden growth rate, a rate of growth in the money supply consistent with hitting the Chinese inflation target at 3%. They have virtually no inflation in China. It's 0.2%, and it's very slow real economic growth. And the reason for that is that the money supply is only growing at about 7% per year, and the golden growth rate a tad over 11%. Now, let's get more into dynamics of things that are going poorly, let's say, and might end up going even more poorly. One is the war in Ukraine, which is, in its 3rd year. We've got a big war going on in the Middle East. We've got the U.S. just itching to get in a war with China, of all things. And then we've got a lot of little things going on that are very bad, like the civil war in Sudan. I mean, we're going to have a huge famine in Sudan, and we're talking about big numbers. I mean, it may be over 1 million people. So there are a lot of uncertainties associated with these wars, as well as the dysfunction in the political scene and the economic slowdown. I don't think much of any of this is priced into the markets at all. And remember, when you say the markets, the only market really that counts is in the United States. 70% of the market cap of all the equity markets in the world is accounted for by the U.S. markets. In 1980, that number was only 30%. It's grown tremendously. And so the U.S. capital market just completely dominates everything. So when I'm really talking about the markets, we're talking about the U.S. market, and the U.S. market is overpriced, overvalued, and overhyped. I think the U.S. economy is overhyped. I think AI is overhyped. I think Bitcoin is overhyped. And by the way, it's overhyped because everyone is on the overhyped bandwagon. The whole idea of Bitcoin, because this does get into economic growth, what you're doing is funneling potentially liquid resources. In other words, the difference between the amount of your income and the amount of your consumption is what? Savings. And you save because, remember, the new book I have out with Leland Yeager, Capital Interest and Waiting. What's waiting? Waiting is not consuming all of your income and waiting to receive a return, an interest rate, and consume later rather than consuming everything now. Now, diversion of waiting or savings into Bitcoin does what? It puts a drag on the economy because those savings are not invested in real capital assets that produce things. It's like buying old masters. It diverts waiting and savings into old masters. It just sits there and is never invested in bankable projects that actually produce anything and increase productivity and so forth in the economy. And if we don't increase productivity, we have a real problem because that fundamentally underlies improved standards of living and prosperity in an economy as increases in productivity. So I think that's enough on the strategic reserve. I'm completely opposed to it. I think it's the stupidest idea. But it's part of this overhyped aspect of things going on and overpriced and overvalued. In a way, there's not much he can do about it because it is baked in the cake, because the effect of monetary changes in the supply of money, they go through a transmission mechanism. You change the supply of money, and it takes a while for it to work its way through the system. But what is happening right now to the data we are viewing about inflation, about bond yields and things, real economic activity, those were all caused by changes in the money supply that happened maybe even 3 years ago. This idea somehow that you can just turn a switch and change things overnight, it doesn't happen that way. There is one aspect that you can change right away, and that's business sentiment. Let us assume that after January 20th, this euphoria surrounding Trump right now, let's say that continues or even increases. That aspect of confidence would mitigate to some extent the effect of the changes in the money supply that are eventually going to cause the economy to slow down. You see, they kind of offset a little bit. The Fed's target is 2%. So if we take that as being the target, then they should be organizing monetary policy in such a way that the broad money rate of growth measured by M2 was about 6% per year. That's what it was, by the way, through almost all the Greenspan years. So that's the theory, okay? That's the forward-looking number and everything. If we go back historically, look at Greenspan in the 1990s. That's about what was happening. The money supply was growing about 5 or 6%. The inflation was a little tiny bit below the target. Economic real growth was good. Everything was stable. By the way, you had Clinton in the White House, and the Speaker of the House was Newt Gingrich, and they were battling it out. But the result was fiscal policy was, in fact, very stable and very tight. Clinton was the most conservative fiscalist we've had since World War II. He was even more conservative than either Dwight Eisenhower or Ronald Reagan. We don't know what Trump's going to do, and we don't know what counterattacks and retaliatory moves that those who are facing new tariffs will react with. So he obviously has some kind of models they're using to indicate what effects the tariffs would have. But remember, the tariffs won't have any effect on inflation. They will affect the prices of certain goods and services, and those price changes are relative price changes. They're not changes in inflation. They're changes in particular goods and services relative to other goods and services. So tariffs don't cause inflation. Changes in the money supply cause inflation. Let's say the whole thing in their modeling exercise at the Fed is so uncertain, they decide to do nothing relative to when the tariffs were put in. If that's the case, then nothing changes. The money supply will go in the direction it had previously been going in, and inflation will be going in the same direction that it was going in, and basically nothing will change. If they react, by the way, to tariffs, if their model shows them that somehow tariffs would be going up that would affect the overall price index, the consumer price index, for example, in a negative way, meaning that prices would be going up. Inflation would be going up, I should say, not the relative prices, but inflation would. Then they would probably react by tightening and slowing the money supply, which means that actually the tariffs caused what? The tariffs began. The reaction of the Fed would be to tighten up the money supply and slow it down. And that would eventually do what? It would actually slow the CPI. It wouldn't increase it. It would be just the opposite of what everybody's saying right now. Everybody's saying that tariffs that Trump's going to impose will create inflation. Well, that whether we have more inflation or less inflation depends on the Fed. And if for some reason the Fed reacts to increasing tariffs by tightening the money supply, we'll actually get not an increase in inflation, we'll get a decrease. Sometime during next year, 2025, I do think that the headline CPI number will drop below the Fed's target of 2%. Now, if that happens, by the way, the interesting part from an investment angle, because the investment, Wall Street just has this all wrong. Yields on bonds follow inflation. So if what I just told you about, based on the quantity theory of money, was that inflation will fall from where it is now, 2.7%, to something below 2%, what's going to happen to bond yields? They're going to go down. So that means like the 10-year bond right now is a tremendous trade. You should be buying it. If you do buy it, the yield on that bond is good now, but it's going to go down. You'll be able to realize a capital gain on that investment. They think that the bond market is bought into this idea that fiscal deficit will go up in the coming years, and that will cause the federal government to be forced to issue more bonds. And the only way people will buy those bonds is if they're getting a higher yield off the bonds. That's not the way bond markets work. Bond yields follow inflation, and inflation follows changes in the money supply. So again, you have to start with the changes in the money supply. That will give you changes in inflation, again, with a long lag between changes in the money supply and inflation. And eventually, yields will follow the inflation. Now, where the bond market gets followed up, they've forgotten, because none of them learned their monetary economics very well, amazingly. They've forgotten to be looking at what's been going on to the money supply a couple of years ago. They're looking at what's going on today. There's something, they're overhyped in a way. Let us just take something like lithium. Lithium has been in the tank now collapsed in the last year and a half, 2 years, its price. And everybody says, oh, it's going to stay in the tank because lithium, one of the big uses, by the way, is batteries. And the sales of electric vehicles isn't as robust as everybody thought it was going to be. So the demand for lithium is not going to be there. And so in a way, you get a bearish overhype. You can have bearish overhypes as well as bullish overhypes. Lithium is an example of a bearish overhype. That would be one. And there are other commodities, by the way, that fall into this category.